setting the asset allocation, determining how much risk is going to be taken, determining the dispersion of the assets across different asset classes or risk premia is the single most important investment job that they can undertake.
When it comes to deciding between the different asset classes that the scheme should pursue, that's where trustees should concentrate their attention.
The difference between a high risk strategy and a low risk strategy will make a huge difference to overall returns over the long life of the scheme, and in fact of course the returns in the very short run, because it'll be very variable. So it's all the other decisions in my view pale into insignificance against that one.
The question is, what is an ideal match for the liabilities? Now, historically, it was always thought that once an individual had retired, you knew what his liabilities were, you knew what the level of the pension was, you knew what inflation rate was going to be, and you should have investments that match that liability. The problem is that because people are now living so long, in the old days they normally drew the pension for 3 years, 4 years maybe, and now people are beginning to draw pensions for up to 30 years. And buying gilts for 30 years sounds sensible, but is actually a mistake. So there's a big debate in the industry at the moment about what the right asset matching is for the liabilities. Some of the banks are pushing lots of complicated investments like swaps and derivatives and gilt packages, which they say match the liabilities. Other advisors say that's an inappropriate investment structure. What you're looking for is how will the investments perform over the next 30, 40 years. And by and large, equities and those kind of investments, alternative investments, equities, property, forestry, all those kind of things, are probably more sensible, more attractive to try and meet the liabilities.
Liability-driven investment is an interesting technical concept. What it articulates is a clear perspective that if a pension fund knows its liabilities, it ought reasonably to consider controlling the risks of the assets not delivering against the liabilities that have been determined. In practice, however, it throws very considerable onus and emphasis on the quality of the assumptions with regard to the future liability.
Yeah, I mean, I would say that the thing that trustees should start with is thinking about where are the returns going to be delivered from. So not thinking about asset classes, but thinking about the return premium from a different asset class and how is it derived. And we like to think about a number of different risk premia that are expected to deliver a return, and to try and get trustees to think about spreading their risk across these different premia. And as an example, one of those would be illiquidity. You get paid some benefit from tying up your money and not having instant access to it. You can get that from a number of sources, and you would want to have a proportion of the overall return that you expect to get delivered from this illiquidity premium, and then you'd want to spread that across a range of asset classes that deliver it.
Well, firstly, diversification is extremely important. You only have to look at the different returns from asset classes over the past year or so to see that different asset classes at any one time can deliver very different results. However, the bad news is there's no free lunch. The reason for that is, okay, you can get your good risk mitigation through diversification most of the time. However, the relationships between asset classes vary all the time. If you look at the chart here that we use sometimes with clients, the red boxes show highly correlated asset classes, and this is over a period 5 years to the end of 2007. And as you can see, in a time of plentiful liquidity, to cut a long story short, all boats were floated up on a rising tide. Asset classes were very highly correlated. It really didn't matter too much where you put your money. Then let's look at the chart for the 5 years to the end of May of 2009. A very different picture, very few highly correlated asset classes. And we would argue that the most important thing, besides being aware of the different risk and reward attributes of different asset classes, is to make sure you build enough flexibility into your asset allocation, into your diversification of the portfolio, to make sure you're not locked into effectively a losing strategy at any one time.
These days, the dividing line between different asset classes isn't as clear as it used to be. There are different sorts of bonds, different sorts of equity, different means of accessing property, different ways of stewarding cash. It's more important that trustees focus in on return-seeking assets, value-protecting assets, and once they've got that broad delineation clear in their own minds, then the other issues are of a second order.
If we go back to first principles, a fund has to begin with a strategic perspective of how it is going to manage its assets against its liabilities. And from a traditional point of view, that has very much always involved, first of all, determining a policy asset allocation and then determining who will manage those assets. Now, I have to say that if you subscribe to that perspective, it is very much because you believe that the quality of the model that drives that policy asset allocation is appropriate and information-rich. If you do not believe that modelling markets gives that quality of input, then reasonably you may want to have other people being able to pull levers to maximise returns, therefore going back to the old model where people had broader discretion to vary asset allocation through time.
If you look back, balance management was a one-stop shop. So you said, which is the best person to advise me on investments, taking into account everything you know about the investment situation today. And the investment manager could decide to put some money overseas, he could put some money in the UK, but then if he put money overseas, he did it perhaps because he thought that dollar earnings would be good. And so you integrated the asset allocation and the stock selection together in one package. Today that just doesn't happen. The specialist manager purchases equities totally in isolation to what's being done on asset allocation.
I think it was some disillusionment with the skills of managers that led to the advent of more specialist approach. People had to prove themselves in a particular asset class. That's well and good, but I say if you take away the ability to see the wood and the trees as a result of that trend sort of running its course to the point where everyone can see a tiny little piece of the puzzle but not the whole thing, then you're going to get the picture all wrong. I think it would be fair to say that we're very much at the exploratory stage of a number of pension funds coming to us, particularly ones who've known the Newton approach for many years and appreciate how we're trying to pull together a portfolio and have perhaps confidence from that experience that we can do it well. They've come to us and asking not so much for the old-fashioned balanced approach, but a newer one that is focused on delivering an absolute or a real return.
It's something I've always struggled to understand, why UK pension trustees are so totally resistant to investing in anything other than bonds and equities. And it is a largely UK phenomenon. If you go to the Netherlands, if you go to Australia, if you go to Sweden, if you go certainly to the United States, you will find a much more open attitude towards so-called alternative assets. And it's probably no accident, no coincidence that it's mostly in the UK where you find the pension funding crisis today.
I mean, yes, there will have been opportunities. It's clear looking back that investing in a wider range of diversified assets would have benefited, particularly in years up to last year when markets all pretty well fell together. But equally, you've got to look at trustees' other roles and responsibilities, and to think that a trustee body can quickly move in the way that some other funds can is probably asking too much of that trustee board.
A number of years ago, US Endowments articulated a very clear perception that if you stuck with traditional assets, you would have a bumpy ride in exchange for liquidity. Endowment funds, on the other hand, said, well, actually, we think we can be more intelligent about this. We think that we can find assets that are alternative, that offer the promise and prospect of stronger long-term real returns, which are inefficient in terms of pricing, and where actually we can pursue a return associated with illiquidity because we can take a long-term view. More recently, there have been some serious doubts cast over this approach, not least of which has been the whole question of illiquidity and reasonable returns. Endowments quite naturally have wanted to access capital, but have actually discovered that realising funds from the sale of private equity, from real estate and from other assets has proven to be very difficult, and even where sale has been possible, it has been at very depressed pricing.
Find out what your neutral position is. It's no point in deciding how much risk you want to take until you know what zero risk is. So have a view about what your neutral position is. People used to think it was perfectly realistic for a pension fund to hold 80% of their assets in equities and maybe a lot of the rest in property, and that really wasn't. That was too much risk. They didn't know what neutral was. Have an idea about what a neutral sort of number would be, and then think about how far you want to deviate from that. And remember that every time you deviate from that, you're taking a little bit more risk, and make sure you're getting more return.
I think the long term is easier to think about than the short term. Don't get blown off course by what's happening in short term noise, but just focus on the long term and try and understand the long term forces at play in asset allocation markets.